Every trader enters the stock market with a dream. The dream of financial freedom. The dream of finding that one stock that changes everything. But most traders fail because they do not know the rules of the game. Mark Minervini was once one of those traders. He struggled, lost money, and felt the pain of mistakes. But instead of giving up, he studied the market with intensity. He searched for patterns in the greatest winning stocks of history. He learned how to protect his capital and how to multiply it when the odds were right. Over time, he transformed himself into one of the top traders in America. He even became the United States investing champion. This book is his blueprint. It is not about luck. It is about building a system that works in real life. Minervini calls it the Superperformance System, a method to find and ride stocks that can deliver extraordinary returns. The book is divided into 3 parts. The first part explains the Superperformance System itself. You will learn about superperformers, chart patterns, the trend template, and the Volatility Contraction Pattern. The second part shows you how to find these stocks by focusing on fundamentals, qualities of winners, and risk management. And the third part takes you deep into the tactics of entries, exits, and trading psychology. Each part builds on the one before it. Together, they form a roadmap for anyone who wants to trade like a stock market wizard. So let us begin our journey. We start with Part 1. The foundation of everything. The Superperformance System. Part 1. The Superperformance System. Every great journey begins with a foundation. In trading, that foundation is a system. A method that tells you what to look for, when to act, and how to protect yourself. Mark Minervini calls this method the Superperformance System. Why superperformance? Because ordinary returns are not enough to change your life. The market is full of average stocks that rise a little, fall a little, and keep you stuck. But history shows us something extraordinary. Every decade, a handful of stocks rise hundreds or even thousands of %. They transform small investments into fortunes. These are the superperformers. The Superperformance System is built to help you identify these rare winners. It combines fundamentals, technical patterns, and strict discipline. It gives you rules to follow, so you can stop guessing and start trading with clarity. This part of the book explains the core ideas. It begins by showing what superperformance stocks really are. Then it takes you into the patterns they follow, the trend template that guides them, and the volatility contraction pattern that signals explosive breakouts. By the end of this part, you will understand how to recognize potential champions before they become obvious to everyone else. And it all starts with the first chapter. The story of stock market superperformers. Chapter 1. Stock market superperformers. When you think about the stock market, what comes to mind? For many people, it is a place of endless numbers, confusing charts, and unpredictable movements. But if you step back and look carefully, a different picture appears. Behind all the noise, there are extraordinary stories. Stories of companies that went from being unknown to becoming household names. Stories of stocks that multiplied 5 times, 10 times, or even 50 times in just a few years. These are not accidents. They are what Mark Minervini calls superperformers. A superperformance stock is a stock that grows far beyond the average. While most stocks move up or down with the market, superperformers rise at an extraordinary pace. Think of companies like Apple in the early 2000s, or Microsoft in the 1990s, or Amazon after it survived the dot-com crash. At one point, each of these companies was just another name on the exchange. But then something happened. Their earnings exploded. Their products captured the imagination of millions. Their charts began to show relentless upward movement. And investors who recognized these signs early made fortunes. Minervini explains that superperformers are not random. They follow a pattern of growth. Before their big moves, they show specific qualities in both their fundamentals and their price action. If you learn to spot these qualities, you can identify the next winner before the crowd. That is the essence of trading like a stock market wizard. Now, you may wonder, why focus on superperformers instead of safe, stable companies? The answer is simple. Safe and stable companies may give you modest returns, but modest returns do not create wealth quickly. To achieve life-changing results, you need stocks that can multiply your money many times over. It takes only a few super performers to make an entire year, or even an entire career. Minervini also warns that not every fast-moving stock is a true super performer. Some are just hype. They rise quickly and then crash just as fast. That is why a disciplined system is essential. You must look at both the fundamentals and the chart patterns to separate real winners from fakes. Throughout history, the greatest market leaders had common traits. They were often innovators with a new product or service. They showed rapid growth in sales and earnings. They attracted attention from institutional investors. And they created a powerful story that the market could believe in. From Home Depot in the 1980s to Google in the early 2000s, these patterns repeat again and again. So what does this mean for you as a trader? It means you do not need to follow hundreds of stocks or chase every trend. You only need to focus on finding a handful of true leaders. By learning how to identify them, you can dramatically increase your chances of success. Super performance stocks are the engines of wealth creation. They are the reason professional traders can make extraordinary returns, while most investors struggle with mediocrity. Minervini wants you to shift your mindset. Stop thinking of the market as unpredictable chaos. Start thinking of it as a place where a few exceptional opportunities appear every year. Your job is to recognize them, position yourself correctly, and manage your risk wisely. You do not have to be right all the time. You just need to be right on a few big winners. This first chapter is about opening your eyes to possibility. It is about seeing the market not as a gamble, but as a place where patterns repeat. It is about believing that you too can find the next Amazon, the next Netflix, or the next Tesla before the crowd realizes it. And once you understand what a super performer looks like, the next question naturally follows. If these stocks follow a pattern, then what exactly is that pattern? How can we recognize it on a chart or in a company's behavior? That is where we go next. Chapter 2. The Superperformance Pattern. In the previous chapter, we discovered the power of superperformance stocks. We learned that they are not random miracles, but rare opportunities that follow a certain rhythm. The natural question now is this. If superperformance is not random, then what pattern does it follow? This chapter answers that question. Mark Minervini explains that every great stock has a life cycle. It is born, it grows, it matures, and then it eventually declines. Just like living things, stocks pass through predictable stages. But what interests us as traders is one particular stage. The stage when a company transforms from being small and unnoticed into a leader with explosive growth. This stage is what Minervini calls the superperformance pattern. So what does this pattern look like? At the beginning, a company develops something new. It may be a breakthrough product, a revolutionary service, or a bold new way of doing business. At first, the market ignores it. But then sales begin to rise. Earnings grow faster than expected. Word spreads, and more investors start paying attention. The stock begins to build a base, a period where the price moves sideways or slightly up, as big institutions quietly accumulate shares. This base is important. It looks like the stock is resting, but in reality, it is storing energy. Think of it as a coiled spring. When enough pressure builds up, the spring is released, and the stock breaks out. That breakout is the signal that the superperformance pattern is alive. From there, the stock can enter a powerful uptrend, sometimes lasting months or years. Minervini gives many examples. Take Home Depot in the 1980s. Before it became a household name, it spent time building bases and showing strong earnings growth. When it finally broke out, it rose thousands of percent in a few short years. The same story repeats with Microsoft, Dell, Google, and countless others. The details of the companies may differ, but the pattern is always the same. Why does this happen? Because the stock market is driven by human behavior. Investors go through cycles of doubt, belief, excitement, and greed. These emotions play out in price charts. When you see a strong base followed by a breakout, you are witnessing psychology on display. The early believers buy quietly. Then the breakout brings in more buyers. Finally, The crowd rushes in, pushing the stock into a super performance run. For traders, the lesson is simple. Do not chase hype or random movements. Instead, train your eyes to recognize the super performance pattern. Look for a solid base, strong fundamentals, and a clear breakout. That combination is where fortunes are made. But Minervini also adds a word of caution. Not every breakout leads to super performance. Some breakouts fail. Some stocks look promising but lack the true strength behind the move. That is why you must combine pattern recognition with discipline and rules. Never assume. Always confirm with evidence. The beauty of the super performance pattern is that it repeats across decades, industries, and market conditions. Technology, retail, biotech, finance, it does not matter. The same pattern appears again and again because human nature never changes. And if human nature never changes, then the market's greatest opportunities can always be found. Now that you understand the pattern, the next step is to build a framework, a set of conditions that tell you when a stock is truly in a healthy uptrend. Without this framework, you may misjudge the strength of a stock. With it, you can separate real leaders from pretenders. This framework is what Minervini calls the trend template, and that is exactly what we will explore in the next chapter. Chapter 3. The Trend Template. Once you understand the super performance pattern, the next step is clarity. Not every stock that looks promising is ready to run. Some may appear strong, but fail to perform. That is where Mark Minervini's trend template comes in. It is a clear framework for identifying stocks that are truly in a healthy uptrend. The trend template is not complicated. It is a checklist of conditions that a stock must meet to be considered a candidate for super performance. It looks at both the stock's price action and its underlying fundamentals. The idea is simple. You want to trade only with stocks that show real strength, not weakness. So what does a strong trend look like? First, the stock must be above its key moving averages. This shows that the stock is gaining momentum and has been trending higher over time. Second, the stock must make higher highs and higher lows. This pattern proves that buyers are in control and sellers are losing power. Third, the stock's fundamentals must support the move. Earnings and sales should be growing. The company should be outperforming its peers. Without this support, the trend may be short-lived. Minervini also examines relative strength. A strong stock will outperform the market and its industry group. It does not just rise because the market rises. It leads. When a stock shows relative strength, it is more likely to continue moving higher during market advances. Volume is another key factor. Breakouts should occur on increasing volume. Volume confirms that institutional investors are accumulating shares. If the breakout happens on low volume, it may be weak or fake. The trend template ensures that you see these signals clearly. Another element of the template is price structure. A stock should form a clean base or consolidation before breaking out. Random swings or choppy movement suggest uncertainty. Minervini emphasizes patience. Waiting for the right structure reduces risk and increases the chance of capturing a true super performance move. The beauty of the trend template is that it turns judgment into a system. It removes guesswork. It allows you to see the difference between a real leader and a weak imitator. By following the template, you align yourself with the stock's natural momentum rather than fighting it. Minervini stresses that discipline is everything. Even if you find a stock that looks perfect, do not act unless it meets the full template. Patience and rules are what separate professional traders from amateurs. A stock that fails the template today may pass it next week. Waiting is part of the process, not a sign of weakness. When you combine the super performance pattern with the trend template, something powerful happens. You can spot stocks that have the potential to multiply many times over. You can trade with confidence, knowing that your decisions are backed by both technical structure and fundamental strength. But even the best trends can falter if you enter at the wrong time. You need to identify the moment when the stock is coiled, ready to explode. That is where the next concept comes in. The Volatility Contraction Pattern, or VCP, shows the precise moments when a stock is ready to move sharply higher. It is the final piece of the puzzle before you take action. In the next chapter, we will explore the VCP in detail. You will learn how to read price contractions and recognize the low-risk points for entry. By mastering the VCP, you can find opportunities that few others see and capture gains before the crowd arrives. Chapter 4. The Volatility Contraction Pattern, VCP. Once a stock is in a strong trend, the next question is timing. When is the right moment to buy? When can you enter with the lowest risk and the highest potential for gain? Mark Minervini's answer is the Volatility Contraction Pattern, or VCP. It is one of his most powerful discoveries and a key tool for identifying super-performance stocks. The VCP is a pattern that occurs on the price chart. It shows a stock in a period of consolidation where volatility gradually decreases. In other words, the swings in price become smaller and smaller over time. This is a sign that the weak hands are leaving the stock and the strong hands are holding on. It is a quiet accumulation phase where the stage is set for a breakout. Why does this matter? Because buying during the contraction gives you a clear advantage. You are entering before the crowd rushes in. You are buying strength when others see uncertainty. This is the essence of low-risk, high-reward trading. Minervini describes the VCP as a series of tightening ranges. Each contraction is smaller than the previous one. The volume during these contractions also tells a story. Volume often decreases as the stock tightens, signaling that sellers are exhausted. When the breakout finally comes, volume surges, confirming that institutional investors are in control. The beauty of the VCP is that it reveals hidden strength. A stock may look calm or even boring during the contraction, but inside it is preparing for explosive movement. Traders who recognize the VCP can position themselves before the big move begins. This pattern is repeated by the greatest super-performing stocks over decades. It works in technology, retail, healthcare, and almost every industry. Minervini also emphasizes that the VCP is not just a chart trick. It reflects real human behavior. Investors first doubt, then cautiously buy, then gain confidence as the stock proves itself. The contraction is the reflection of patience, discipline, and accumulation by smart money. When you understand the psychology behind it, the pattern becomes much easier to read. Another key point is risk management. The VCP allows you to define your risk clearly. The low of the contraction acts as a natural stop. If the stock breaks below this point, your thesis is invalidated. If it holds, the stock is likely to continue higher. This clear boundary is what makes VCP setups so attractive for disciplined traders. By combining the super-performance pattern, the trend template, and the VCP, you now have a complete framework. You know what super-performance stocks look like. You know how to judge their trend strength, and you know how to identify the precise moments to enter. This is the foundation of Mark Minervini's Superperformance System. As Part 1 closes, you can see the logic. Trading is not guessing. It is about finding stocks with explosive potential and positioning yourself correctly. But knowing patterns is not enough. To succeed, you must also find the right stocks consistently. That is where Part 2 starts. Part 2 begins. We will learn how to find super-performance stocks by combining fundamentals, qualities of great companies, chart patterns, and risk control. This next part will take you from theory to practical stock selection. Part 2. How to find super-performance stocks. Part 1 showed you the Superperformance System. You learned what superperformers are, the patterns they follow, the trend template, and the Volatility Contraction Pattern. Now, it is time to move from theory to action. Part 2 focuses on how to find these extraordinary stocks in the real market. It is one thing to understand patterns. It is another to locate stocks that actually fit those patterns. Here, Mark Minervini explains how to combine fundamentals, stock qualities, chart patterns, and risk control to create a short list of potential winners. You will learn which numbers matter, what makes a company truly exceptional, and how to separate real opportunities from fakes. This is the practical side of trading, the part where preparation meets opportunity. The first step is understanding the fundamentals. Without solid financial health, a stock cannot sustain a super performance move. That is exactly what we explore in the next chapter. In Chapter 5, You will discover the key financial metrics and growth indicators that matter most when searching for the next stock that can change everything. Chapter 5. Fundamentals to focus on. Finding a superperformance stock begins with the company itself. No chart pattern, no breakout, no timing signal can make up for a weak underlying business. Mark Minervini stresses that strong fundamentals are the backbone of every superperformance stock. They show whether a company can grow over time and sustain investor confidence. Without them, even the best-looking stock on a chart may fail. Not all financial metrics matter equally. Minervini warns traders to focus only on the numbers that indicate real growth. For example, book value or dividend yield may be irrelevant for a rapidly growing stock. Instead, you should concentrate on earnings growth, sales growth, profit margins, and return on equity. These metrics reveal whether a company is improving its business and creating value for shareholders. Earnings growth is critical. A stock cannot multiply several times if profits remain stagnant or grow slowly. Look for companies that grow earnings consistently quarter after quarter. Even better are those whose earnings growth is accelerating. These companies are often industry leaders or innovators, and they can outperform the market for years. Sales growth is equally important. Revenue expansion shows that a company is attracting more customers or selling more to existing ones. It confirms the sustainability of earnings growth. Earnings growth without sales growth may be temporary, achieved through cost-cutting or one-time events. Superperformance stocks show real, tangible growth in both sales and profits, giving them a solid foundation for price appreciation. Profit margins are another key factor. Expanding margins indicate a company is becoming more efficient and extracting more value from each sale. High margins suggest a competitive advantage, while improving margins signal smart management. Margins also provide fuel for future growth because a company can reinvest profits into new projects or innovation. Return on equity, or ROE, shows how effectively a company uses its capital to generate profits. High and improving ROE demonstrates strong management and a sustainable business model. Low or declining ROE often signals inefficiency or poor capital allocation. Superperformance companies consistently earn high returns on invested capital. Beyond numbers, qualitative fundamentals matter just as much. Is the company innovating with new products or services? Is it gaining market share over competitors? Is management ambitious, competent, and aligned with shareholders? These non-numerical traits often separate true leaders from average performers. A stock with great numbers but weak leadership may never reach its potential. Minervini also highlights the importance of context. A strong stock should outperform its industry group and the broader market. Relative strength confirms leadership. It shows that the company is rising because it is fundamentally stronger, not just because the market is moving up. Fundamentals alone are not enough, however. A company may be growing rapidly, but if the stock does not show strength on the chart, it is not ready for entry. Charts provide timing, while fundamentals provide conviction. Together, they form the foundation of a superperformance trade. Finally, discipline is key. Do not be tempted to buy a stock simply because it is popular or hyped. Follow the numbers. Look for accelerating earnings, growing sales, improving margins, and strong ROE. Combine this with qualitative assessment and relative strength. By doing so, you filter out weak candidates and focus on companies capable of delivering extraordinary results. Once you understand the fundamentals that matter, the next step is to examine the qualities that make a stock a superperformer. Chapter 6 will guide you through those traits, helping you identify potential winners before the crowd notices them. Chapter 6. The qualities of a superperformance stock. Understanding the fundamentals is only the first step. The next step is identifying the qualities that distinguish true superperformance stocks from ordinary companies. Mark Minervini emphasizes that certain traits appear consistently in stocks that deliver extraordinary returns. By recognizing these traits early, a trader can position themselves ahead of the crowd. One of the most important qualities is leadership within the industry. A superperformance stock is rarely a laggard. It usually belongs to a company that is a market leader or has the potential to become one. Leadership may come from a breakthrough product, an innovative service, or a superior business model. The key is that the company is outperforming its peers and shaping the future of its sector. Innovation is another critical quality. Super-performance companies often introduce products or services that change the rules of the game. Think of Apple with the iPhone, Amazon with e-commerce, or Tesla with electric vehicles. Innovation creates excitement, attracts attention, and drives growth. It also establishes a narrative that investors can believe in, which fuels demand for the stock. Earnings and sales acceleration are essential traits. A stock may grow steadily, but super-performance stocks accelerate faster than the market expects. Look for companies whose quarterly earnings and sales are consistently beating estimates. Acceleration signals momentum and shows that management is executing effectively. It is a sign that the company is gaining strength and leaving competitors behind. Another quality is strong management. Leadership matters more than any chart pattern or technical indicator. Successful super-performance stocks usually have ambitious, disciplined, and capable executives. Management should have a track record of making smart decisions, allocating capital efficiently, and driving innovation. Weak or distracted management often prevents a promising company from reaching its potential. Minervini also highlights relative strength. A strong stock will outperform not only the general market, but also its industry peers. Relative strength shows that the stock is leading the market, not just following it. This trait is critical because super-performance stocks often continue rising even during broader market corrections. They stand out, and the market rewards their strength. Liquidity and market interest are additional factors. A stock must have enough trading volume to allow institutional investors to accumulate shares. Super-performance stocks often attract both retail and institutional interest, creating momentum and reinforcing the trend. Without sufficient liquidity, even a strong company may fail to perform in the market. Minervini emphasizes that no single quality guarantees success. Super-performance stocks usually combine multiple traits. They are innovative leaders, accelerating earnings, outperforming their peers, guided by strong management, and exhibiting relative strength. The more traits present, the higher the probability of success. It is also important to remain selective. Not every company with strong earnings or innovative products will become a super performer. The key is to find those rare stocks that meet most or all of these criteria. Focus on quality, leadership, momentum, and the narrative that drives investor confidence. By understanding these qualities, a trader can filter the universe of thousands of stocks. Instead of chasing random opportunities, you concentrate on a select few with the potential for extraordinary returns. This sets the stage for the next chapter, where we explore chart patterns and price action, the visual signals that confirm these qualities and help you decide when to enter. Chapter 7 will take the analysis from the company level to the chart, combining fundamentals with technical precision to pinpoint high-probability trades. Chapter 7: Chart Patterns and Price Action. Once you have identified a strong company with super performance qualities, the next step is timing. Even the best stock can disappoint if you enter too early or too late. Mark Minervini emphasizes that chart patterns and price action are essential tools for spotting the right moment to trade. They are the visual language of the market, showing the interaction between buyers and sellers. Price action is the heartbeat of a stock. It reflects real-time supply and demand, investor psychology, and market sentiment. Charts tell stories that fundamentals alone cannot. By studying price movements, you can see when a stock is gathering strength, consolidating, or ready to break out. Minervini stresses that understanding price action gives traders a critical edge. One of the first patterns to recognize is the base. A base is a period of consolidation where a stock moves sideways or slightly up. During this phase, weak hands sell and strong hands accumulate. Bases come in different shapes: cup with handle, flat base, or ascending base. But they all serve the same purpose. They prepare the stock for a powerful breakout. Volume is an essential part of reading charts. Increasing volume on breakouts confirms that institutional investors are entering. Decreasing volume during a base shows that selling pressure is fading. By combining price and volume, you can assess the quality of a move. A breakout without volume is often a trap, while a breakout with strong volume signals conviction. Trend lines and moving averages are additional tools. A stock above its key moving averages and following a rising trend line is in alignment with the market's momentum. Minervini warns against chasing stocks that defy their trend. Stocks that move against the prevailing trend often fail, no matter how strong their fundamentals may be. Patterns like flags, pennants, and wedges also help traders identify continuation setups. These patterns show temporary pauses in a trend, often followed by another surge in the stock price. Recognizing them allows you to position yourself ahead of the next move rather than reacting after it happens. Support and resistance levels are critical. Support is the price level where buyers step in, preventing the stock from falling further. Resistance is where sellers dominate, capping upward movement. Breakouts above resistance or bounces from support are high probability signals for entry or exit. Minervini emphasizes that charts are not fortune-telling tools. They are evidence of market psychology. Every candlestick, bar, and pattern reflects the collective behavior of investors. By learning to read these signals, you translate the market story into actionable trades. The combination of fundamentals, super performance qualities, and price action is powerful. Fundamentals tell you which companies can grow. Qualities show which have the potential to dominate. Charts tell you when to act. Ignoring any one of these components increases the risk of a failed trade. Finally, chart reading also teaches discipline. It prevents impulsive buying and forces traders to wait for confirmation. Waiting for the right pattern, trend, and breakout is part of trading like a stock market wizard. The next critical topic is risk management and trade sizing. Even with the perfect stock, pattern, and timing, poor risk management can destroy a portfolio. Chapter 8 will guide you on how to control risk, determine position size, and protect your capital while aiming for extraordinary returns. Chapter 8: Risk Management and Trade Sizing. Even the best stock, the perfect pattern, and the ideal timing cannot guarantee success without proper risk management. Mark Minervini emphasizes that protecting your capital is just as important as finding winners. A single bad trade can erase the profits of many good trades if risk is ignored. This chapter explains how to manage risk effectively and size your trades for long-term success. The first rule of risk management is to know your maximum acceptable loss. Every trade should have a stop-loss level. This is the price at which you will exit to prevent a small loss from turning into a catastrophic one. Without a stop-loss, emotions take over, and even strong setups can fail. Minervini insists that discipline in cutting losses is a hallmark of every successful trader. Position sizing is the next key concept. You should never risk too much of your capital on a single trade. A common guideline is to risk only 1 or 2% of your total portfolio per trade. This ensures that a few losing trades will not damage your overall capital. By sizing trades according to risk, you can survive inevitable mistakes and continue to profit from winners. Volatility plays an important role in determining position size. Stocks with higher volatility move more dramatically, so you may need a smaller position to stay within your risk limits. Conversely, less volatile stocks may allow for larger positions. Minervini emphasizes that volatility is not a reason to avoid a stock. It is a factor for calculating risk. Another critical element is risk-reward ratio. Before entering a trade, estimate how much the stock can potentially gain versus how much you might lose. A strong trade has the potential reward greater than the risk. Typically, traders look for at least a 2-to-1 reward-to-risk ratio. This ensures that even a few winning trades can outweigh multiple losses. Minervini also stresses the importance of reviewing trades after they close. Analyze why a trade went right or wrong. Learn from mistakes and successes alike. This review process sharpens judgment and improves future decisions. Emotional control is part of risk management. Traders must resist the urge to increase position size after a win, or hold a losing trade out of hope. Discipline is the foundation of long-term success. No system or pattern will work without emotional control and consistent application of risk rules. Diversification is another tool to manage risk. even super-performance stocks can fail unexpectedly. By spreading risk across multiple high-quality trades, you reduce the chance of a single loss impacting your portfolio significantly. However, Minervini warns against over-diversifying. Focus remains on the few truly strong candidates rather than dozens of weak positions. Trade sizing, combined with stops, reward-to-risk analysis, and emotional control, forms a complete risk management strategy. It allows you to stay in the game long enough to capitalize on super-performance opportunities. No matter how strong a stock is, ignoring these principles can destroy wealth faster than any market crash. The final element of this part is consistency. Applying risk management rules consistently, trade after trade, is what separates professional traders from amateurs. It creates the foundation on which all profits are built. With proper risk control, even a small number of successful trades can compound into extraordinary results over time. Once risk and position sizing are mastered, the next step is to have a structured checklist to evaluate every trade. Chapter 9 introduces the Minervini Checklist, a practical tool to ensure that all critical factors are considered before entering a position. It is the final step in identifying and preparing for super-performance stocks. Chapter 9. The Minervini Checklist. After mastering fundamentals, super-performance qualities, chart patterns, and risk management, the final step in identifying the right trade is discipline. Mark Minervini created a checklist to ensure that traders do not miss critical factors before entering a position. This checklist is not just a formality. It is a framework for consistency, focus, and high-probability trading. The Minervini Checklist begins with the company itself. Ask yourself, is this stock a leader in its industry? Is it growing faster than its competitors? Are earnings and sales accelerating? Does the company have a competitive advantage that can sustain long-term growth? These questions filter out weak or average businesses and focus your attention on true leaders. Next, examine the chart. Is the stock in a clear uptrend according to the trend template? Does it show a well-formed base or consolidation pattern? Is there evidence of the volatility contraction pattern? Confirm that the price action matches the story told by the fundamentals. A strong company without chart confirmation is not yet ready for a low-risk entry. Volume is also a critical checkpoint. Look for increasing volume on breakouts and decreasing volume during bases. Volume confirms participation by institutional investors and the strength of the move. Without volume, even a technically perfect breakout may fail. Risk management is another essential point on the checklist. Have you defined your stop loss? Does your position size match your risk tolerance? Is the potential reward significantly higher than the risk? Following the checklist ensures that each trade is controlled and disciplined. Relative strength is the next factor. Compare the stock to its industry and the broader market. Is it outperforming? Super-performance stocks usually lead their sector, not lag behind. Relative strength confirms that the stock is attracting attention and money, increasing the likelihood of continued upward movement. Psychology and timing also appear on the checklist. Are you entering with the trend or against it? Are you emotionally prepared to follow your plan, including taking losses when necessary? Discipline and emotional control are often the difference between success and failure. Minervini also encourages reviewing the checklist regularly. Before entering, go point by point. If a stock fails on even one critical factor, it may be better to wait. Consistency is more valuable than chasing every opportunity. By sticking to the checklist, you reduce mistakes and increase the probability of capturing super-performance moves. The Minervini Checklist combines all the lessons from Part 2. It ensures that fundamentals, chart patterns, risk management, and psychology align before committing capital. This transforms trading from guesswork into a structured, repeatable process. It allows you to filter thousands of stocks down to a handful of high-probability candidates. Once the checklist is mastered and applied, traders are ready to move from analysis to action. Part 3 will guide you through trading tactics, psychology, and the rules for entry and exit. It is here that knowledge becomes execution. You will learn how to buy, when to sell, how to handle losses, and how to cultivate the discipline needed to consistently achieve super-performance results. Part 2 ends with this clear principle. Finding the right stock is just the start. The next step is trading it correctly. Part 3 will show you exactly how to do that. Part 3. Trading Tactics and Psychology. Finding superperformance stocks is only half the battle. Even the strongest stock can fail if you enter at the wrong time, manage risk poorly, or let emotions control your decisions. Part 3 focuses on the art of execution, the tactics and psychology that turn research into profits. In this part, Mark Minervini guides traders on how to buy at optimal points, sell at the right time, and handle losing trades with discipline. You will learn rules for entering positions with precision, managing risk while aiming for maximum gains, and mastering the emotional challenges of trading. This section also explores the mindset of a successful trader, showing how consistency, patience, and mental discipline create long-term success. By the end of Part 3, you will have a complete framework, identifying the right stock, confirming its strength, timing your entry, managing risk, and trading with the discipline of a professional. The journey begins now with Chapter 10, Entry Points and Buying Techniques, where timing meets opportunity. Chapter 10, Entry Points and Buying Techniques. Even after identifying a strong stock with the right fundamentals, qualities, and chart confirmation, timing your entry is critical. Mark Minervini emphasizes that buying at the right moment can dramatically increase profits and reduce risk. A few dollars difference in price can determine whether a trade succeeds or struggles. The first key concept is buying on strength, not weakness. Many traders make the mistake of buying a stock after it has fallen, hoping for a bargain. Minervini calls this catching a falling knife. Superperformance stocks are bought when they show evidence of demand and momentum. This means the stock is breaking out of a base, forming higher lows, or displaying relative strength versus the market. The Volatility Contraction Pattern, or VCP, is one of the most powerful tools for timing entries. A stock gradually contracts, forming smaller price swings. This contraction signals that weak hands are leaving and strong hands are accumulating. Buying near the tightest point of the contraction gives the lowest risk entry with the highest potential reward. Waiting for this precise moment is critical. Early entries before the contraction tightens increase risk, while late entries reduce potential gains. Volume is another essential indicator. Breakouts should be accompanied by rising volume, confirming that institutional investors support the move. Minervini warns that low-volume breakouts are prone to failure. Volume tells you whether the market believes in the stock's potential or if it is a temporary, weak move. Position sizing complements entry strategy. Even a perfect setup can fail if too much capital is exposed. Traders should determine their position size based on risk tolerance, stop-loss distance, and overall portfolio management. Pyramiding is a useful technique. After the initial position proves successful, additional shares can be added in stages. This allows traders to participate in extended moves while controlling risk. Stop-loss placement is a crucial part of entry. A well-defined stop prevents small losses from becoming catastrophic. Minervini often places stops just below the base, the recent support, or the lowest point of the VCP contraction. If the stock violates that level, it signals that the trade thesis is no longer valid. This disciplined approach protects capital and preserves the ability to trade again. Patience is a fundamental principle. Do not force an entry if the stock is not ready. The right trade may take days or weeks to develop. The market rewards traders who wait for confirmation rather than chasing every opportunity. Patience reduces risk and increases the likelihood of success. Market context also matters. A strong stock in a weak overall market may struggle to rise. Conversely, strong stocks in a healthy market trend tend to accelerate faster. Aligning entries with market trends enhances the probability of sustained gains. Finally, entry is both technical and psychological. Confidence comes from preparation, following the checklist, and adhering to rules. Buying without structure, confirmation, or discipline is speculation, not trading. By combining timing, pattern recognition, volume confirmation, risk control, and patience, traders can enter with a clear edge. Once entries are mastered, the next skill is selling. Chapter 11 will teach the rules of when to sell, how to protect profits, and how to avoid common mistakes that can reduce overall returns. Selling, Minervini stresses, is as important as buying, and mastering it separates average traders from stock market wizards. Chapter 11. Selling Rules and When to Sell. Buying the right stock at the right time is only half the battle. The other half is selling correctly. Mark Minervini stresses that knowing when to sell is just as important as knowing when to buy. Poor selling decisions can erase gains, while disciplined selling locks in profits and protects capital. The first principle is to let profits run, but protect them carefully. Superperformance stocks can continue rising for months or even years. Traders should not sell too early out of fear. However, waiting too long can be dangerous if the stock shows signs of weakness. The goal is to balance patience with discipline. Trailing stops are a key tool. Once a stock moves favorably, Minervini recommends adjusting your stop loss upward to protect gains. This allows the trade to continue running while limiting potential losses if the trend reverses. A stock may experience small pullbacks even in a strong uptrend, so stops should be wide enough to avoid being shaken out by normal volatility. Selling in stages is another effective strategy. Instead of liquidating the entire position at once, consider taking partial profits as the stock rises. This locks in gains while still allowing participation in further upside. Stage selling also reduces emotional stress and avoids impulsive decisions driven by greed or fear. Minervini emphasizes the importance of technical signals when selling. Price action often reveals early signs of trend reversal. Breaks below key support levels, major moving averages, or the low of a base can signal that it is time to exit. Ignoring these signals can turn a winning trade into a losing one. Relative weakness is another red flag. If a stock begins to underperform its industry or the broader market, it may be losing momentum. Even if fundamentals remain strong, market sentiment can shift quickly. Traders must respect these signals and act decisively to preserve capital. Psychology plays a central role in selling decisions. Many traders hold winners too long out of greed or hope for more gains. Others may sell prematurely out of fear. Discipline is the key. Follow your rules, trust your plan, and avoid emotional impulses. Mark Minervini warns that emotions are often the biggest threat to profitability. It is also important to differentiate between normal pullbacks and serious weakness. Stocks rarely move straight up. Minor dips within an uptrend are normal and should not trigger a sale. However, a clear break in the trend or violation of key chart patterns requires action. Successful traders learn to distinguish noise from real warning signs. Finally, Minervini stresses preparation for the next trade. Selling is not just an endpoint. It is an opportunity to recycle capital into the next high-probability setup. By exiting correctly, you maintain liquidity and the ability to act when the next superperformance stock appears. Every trade is part of a larger system, not a single event. Mastering selling rules is essential for long-term success. With disciplined entry and exit strategies, traders can maximize gains, minimize losses, and grow their portfolios consistently. The next chapter, Chapter 12, focuses on how to handle losing trades, a skill that separates successful traders from those who fail. Understanding loss management ensures that mistakes do not become catastrophes and that you remain in the game for the long term. Chapter 12. How to handle losing trades. Losses are inevitable in trading. Even the best setups and strongest stocks sometimes fail. Mark Minervini stresses that handling losing trades properly is what separates successful traders from those who fail. It is not about avoiding losses, it is about controlling them and learning from them. The first step is accepting that losses are part of the game. Many traders fear losses and let emotions dictate decisions. This fear can lead to holding onto losing trades too long or making impulsive decisions to try to recover. Minervini emphasizes that acknowledging losses as normal allows a trader to act rationally and protect capital. Stop losses are essential in handling losses. Before entering any trade, define your maximum acceptable loss and set a stop loss at that level. When the stock hits the stop, exit immediately. This discipline prevents a small setback from turning into a catastrophic failure. Cutting losses quickly preserves your capital and keeps you in the game for future opportunities. Emotional control is critical. A losing trade can trigger fear, frustration, or revenge trading. Minervini warns against trying to win back lost money by taking excessive risk in the next trade. Reacting emotionally often leads to a chain of mistakes. Instead, accept the loss, review the trade, and focus on the next high-probability setup. Analyzing losing trades is another vital step. Ask yourself, why did this trade fail? Was it a mistake in timing, analysis, or execution? Was it a random market event outside your control? Learning from mistakes sharpens your judgment and improves future decisions. Every loss is an opportunity for growth if analyzed objectively. Minervini also highlights the importance of position sizing in loss management. Smaller positions relative to risk tolerance ensure that no single trade can damage your portfolio significantly. Even multiple small losses will not threaten capital, allowing you to continue trading and capture future winners. Another key principle is detachment. Do not let losses affect your confidence or decision-making. Successful traders separate individual trade outcomes from overall strategy. A single loss does not define your skill. Consistent application of your system does. Patience and discipline are vital in recovering from a loss. Avoid jumping back into trades too quickly or making impulsive adjustments. Stick to your rules, follow your checklist, and wait for high-probability opportunities. This approach ensures that losses remain temporary setbacks rather than long-term setbacks. Minervini also stresses that controlling losses allows compounding to work in your favor. By limiting damage on losing trades, you preserve capital to exploit winning trades fully. This is the essence of trading like a stock market wizard, letting winners run, cutting losers quickly, and staying consistent. Finally, handling losses is as much psychological as it is technical. Accept them, control risk, analyze mistakes, detach emotionally, and focus on the next opportunity. By mastering this skill, you maintain the ability to trade confidently and consistently over the long term. The next chapter, Chapter 13, focuses on trading psychology and discipline, how to cultivate the mindset necessary to apply all these rules consistently, manage emotions, and sustain super-performance results over time. Chapter 13, Trading Psychology and Discipline. Trading is as much a mental game as it is a technical or analytical one. Mark Minervini emphasizes that even the best system can fail if a trader lacks discipline and control over emotions. Part of becoming a stock market wizard is developing the right mindset to consistently apply rules, handle stress, and make rational decisions. The first principle is emotional control. Fear and greed are the two strongest emotions in trading. Fear can make you exit winners too early or hesitate on promising setups. Greed can make you overtrade, increase position size irresponsibly, or hold stocks too long. Minervini stresses that awareness and control of these emotions is essential for long-term success. Discipline is the next cornerstone. A trading plan is only effective if it is followed consistently. Traders must stick to entry rules, stop-loss levels, position sizing, and selling strategies. Deviating from the plan due to impulses or gut feelings often leads to losses. Consistency, not perfection, is what produces results over time. Patience is critical. Many traders enter trades prematurely, chasing price moves or news. Minervini teaches that waiting for high-probability setups, like well-formed bases or confirmed breakouts, is far more profitable than constant activity. Patience reduces risk and aligns you with the market's momentum rather than against it. Confidence is built through preparation and experience. Using the Minervini Checklist, following the Superperformance System, and managing risk correctly develops trust in your process. Confidence prevents hesitation and emotional overreaction when the market fluctuates. It allows you to act decisively when opportunities arise. Minervini also highlights self-awareness. Understanding your own strengths, weaknesses, and behavioral patterns helps prevent mistakes. Are you prone to chasing losses, overtrading, or ignoring stops? By recognizing tendencies, you can implement strategies to mitigate them. Focus is another key aspect. Avoid distractions and market noise. Traders succeed by concentrating on high-probability setups and ignoring irrelevant information. A clear, focused mind sees patterns, opportunities, and warning signs that an unfocused trader would miss. Journaling and review are practical tools for psychological discipline. Record every trade, including the reason for entry, exit, and emotional state. Review successes and mistakes regularly. This self-analysis reinforces good habits, corrects bad ones, and strengthens mental resilience. Stress management is essential. Trading can be intense and unpredictable. Develop routines, exercise patience, and maintain balance to prevent burnout. A calm, clear mind allows you to make rational decisions even during volatile market conditions. Finally, Minervini emphasizes that psychology and discipline are ongoing practices. They are not achieved once. They are developed and maintained daily. By mastering your emotions, applying rules consistently, and staying patient, traders position themselves to capture superperformance results. The final chapter, Chapter 14, ties everything together. It explores the road to superperformance, showing how consistent application of these principles over time leads to extraordinary results and lasting success in the stock market. Chapter 14, The Road to Superperformance. Becoming a stock market wizard is not about luck. It is the result of consistent preparation, disciplined execution, and the relentless pursuit of improvement. Mark Minervini emphasizes that superperformance is achieved by following a system, mastering risk, and cultivating the right mindset. The first step is integrating all the lessons from the previous chapters. You must combine the Superperformance System, the qualities of strong stocks, chart patterns, and precise entry points. You must manage risk through proper position sizing and stop losses, and you must follow the Minervini Checklist for every trade. Without integration, even the best elements in isolation cannot produce consistent results. Consistency is the key to success. Superperformance is not about occasional big wins. It is about repeated application of rules and strategies that produce positive outcomes over time. Every trade should follow your plan, every decision should be rational, and every mistake should be a learning opportunity. The compounding effect of consistent, disciplined trading separates successful traders from the rest. Risk control remains central. Even strong stocks can fail, and even perfect setups can reverse unexpectedly. Minervini teaches that losses are inevitable but manageable. The goal is not to avoid them, but to limit their impact and preserve capital for future opportunities. Mastering losses ensures that you survive long enough to capitalize on winners. Psychology and discipline are the glue that holds everything together. Emotional control prevents fear and greed from dictating your decisions. Patience allows you to wait for the perfect setups. Focus keeps you aligned with high-probability trades rather than chasing every market noise. By combining discipline with emotional mastery, you maintain a consistent edge in every market condition. Adaptability is also crucial. Markets evolve, and strategies must be flexible. Minervini emphasizes that superperformance traders adjust to changing market dynamics without abandoning core principles. They remain vigilant for new patterns, emerging leaders, and shifts in momentum. Adaptation ensures survival and continued growth. Learning is ongoing. Even seasoned traders review trades, analyze mistakes, and refine their strategies. The pursuit of knowledge, the study of charts, and the understanding of market psychology are lifelong practices. Superperformance is a journey, not a destination, and continuous improvement separates good traders from great ones. Minervini also highlights the importance of confidence built on preparation. By trusting your process, following your checklist, and managing risk, you act decisively without hesitation. Confidence ensures that you exploit opportunities while avoiding impulsive mistakes. Finally, patience and perseverance are essential. Superperformance does not happen overnight. It requires years of practice, learning from mistakes, and disciplined application of strategies. Those who remain focused, controlled, and consistent build wealth and achieve extraordinary results. The road to superperformance is clear. Find strong stocks, follow precise entry and exit rules, manage risk meticulously, and master your mind. Apply these principles consistently, and the market rewards those who are prepared, disciplined, and patient. Mark Minervini concludes by reminding traders that success is a system, not luck. By embracing this system fully, you transform trading into a process of predictable, repeatable results. Superperformance is within reach for those willing to learn, adapt, and execute with discipline every single day. This chapter closes the journey through trade like a stock market wizard. From understanding the Superperformance System to mastering execution, risk, and psychology, the lessons of this book provide a complete roadmap for consistent, extraordinary trading success. Thank you for listening to this summary of Trade Like a Stock Market Wizard by Mark Minervini. If you found these insights valuable and want to learn more about trading, investing, and mastering the stock market, make sure to subscribe to our channel. By subscribing, you will get access to more book summaries, trading strategies, and tips to help you on your journey to financial success. Remember, knowledge is only powerful when applied. Stay disciplined, follow the system, and keep learning. Subscribe now and continue your path to trading mastery.